welcome to the FII View with me, Tanveer Gill. My guest today on the show is Dr. Jerry Webman, who is Senior Investment Officer and Chief Economist at Oppenheimer Funds. He joins me from New York. Dr. Webman has over 25 years of experience tracking politics, markets, and economics. Dr. Webman, thanks very much for taking out the time and speaking with us. I know this is your first interview to an Indian business channel, so thanks very much for taking out the time once again. Now, you visited India last in mid-2011. You wrote a detailed note at that time on India, stating that you were being cautiously optimistic on the market. How much has that view changed since?
Well, I remain optimistic about India's growth potential, and that's reflection in both the debt and the equity markets. You know, obviously we were a little more hopeful about the rate at which India could grow when I last visited there 3 years ago. And there's a little disappointment over the last year or so that growth in India has fallen back under 5%, and I think projected to be under 5% during this year. On the other hand, the long-term advantages that India enjoys, particularly demographic, one of the youngest countries in the world, the tremendous amount of human capital, the intellectual strength of the technical strength in the country. So we expect that growth to regenerate, to reaccelerate in coming years. But we've been a little disappointed over the last year or so at the rate of growth in India.
All right, let's understand your view now of linking politics, economics, and markets for India. As an FII, how do you see the political situation evolving ahead of elections? How much do elections hold the key for India being re-rated as a market? Right now, the average holding for India is 6% in global portfolios, mirroring the MSCI index composition. How much can that go up by?
You know, I don't think the election in any of the world's great democracies, India and the United States being, of course, two of them, I think these elections are very important for the quality of life of citizenry, but for markets, honestly, they're secondary to the ability of the economy to grow and companies within the economy to profit from however the economy does grow. If you'll excuse me, one of the things I've said a lot to U.S. investors who've been concerned about our own less than perfect political situation over the last several years is that, you know, disliking the government is not an investment strategy. And I think investors are wise to think about that in India, whether the coalition that they prefer wins the parliamentary elections or fails to win, or as we think is probably most likely what the poll data says right now is really a lack of any majority in the Lok Sabha after the spring elections. So I think people in the markets need to focus on how money is made and who makes it and how efficiently they do so, what their prospects are, and save their political thinking for their role as a participating citizen.
I know, even though you won't comment on specifics, most analysts believe that the market has already priced in a clear mandate, so to speak. What scenarios politically would influence your view on India?
Well, you know, BJP has, in the world's eyes, been associated with some of the pro-market reforms that they instituted last time they were in government. It's well to remember that even though reform has been slow to move ahead, and by reform I mean liberalizing the financial markets, I mean further disinvestment of state-owned enterprises and so forth. We have to remember that Congress was really the first to start those kinds of reforms 20-some years ago. So both major coalitions have some history of moving in directions that investors have found to be friendly. So, you know, a shift in government at this point may accelerate reforms. We'll just be watching to see whoever takes charge, which part of their heritage they emphasize. We would obviously like to see further privatization. We'd like to see further reforms of labor laws, investment laws. We'd like to see further investment in infrastructure and so forth. Whoever ends up controlling Parliament, whatever coalition it ends up being once the elections take place.
Yeah, but just for somebody who can correlate markets and politics, what do you foresee the markets to do around the event, around election?
Well, you know, markets, the poll results that I've seen most recently suggest that it will be difficult to form a government. And so the markets, you know, the Senex is off a little bit this year. There are just many reasons for that. But I'm sure that current markets are reflecting a period of difficult coalition building once the election passes, and maybe some difficulty in cohesion at the center. So the markets are already anticipating that. I think once the election is over, markets will be looking to see how quickly any government can move ahead with the kinds of investment needs and reforms that we talked about a few minutes ago. So I think the market right now is probably looking at a hung parliament with some protracted period of negotiation before a government gets put together. So we shall see, but I don't think the market's going to be terribly shocked by any of the likely outcomes.
All right, let's talk macros then. In your earlier note on India, you had stated that great growth in India doesn't mean great growth for Indian companies. It could mean, however, better growth for companies trading with India. Explain that theory a bit, because a large part of the India story is predicated on revival in domestic GDP growth, translating into strong earnings for Indian companies.
Well, you know, there's the one thing that surprises a lot of people is a statistical relationship, or better to say lack of relationship. You know, the performance of a country's stock market and the growth rate of its economy bear absolutely no statistical correlation. And this is across decades and across countries around the globe with actively traded equity markets. So what's true of the world is also true of India. Many of India's great companies do a considerable amount of their business outside of India, and there are many global companies in consumer products, infrastructure provision, some of the great capital goods companies that do a lot of business in India but aren't based in India. So it's important to understand where a major economy like India, how much it's growing and how much demand it will have for both consumer goods and capital goods as a way of understanding who has opportunities there. But then you turn it around and look at some of the great, particularly technology and pharmaceutical companies in India that do a great deal of their business outside of India's own borders. And so it's not, in any case, you want to ask, a bit of an oversimplification, but in my opinion, it's more important to understand where a company's customers are than to understand where its chief executives have their homes, or where they regularly meet, play golf, whatever.
So which sectors are you betting on in India? You know, which are the sectors that you like aside of IT and pharma, which are the export-oriented themes?
Well, we are concerned about companies that are very geared toward growth in India. You know, our favorite sectors in India remain technology, and to some extent some of the privatized parts of financial services as well, that where over time we found some investment opportunities. But it's very much on a company by company upward basis. One of our interests in some of the European luxury good companies, some of the basic consumer product companies based perhaps in North America or in Europe, have to do with growth in India. And if Indian growth is slower, that becomes on the margin a concern for some of these consumer goods, of all the full range of consumer goods, who've expected to sell into India. It's also a concern for some of the capital goods manufacturers, particularly ones that might be geared toward infrastructure building. So you think about, you know, heavy machinery and so forth. If investment in India does not accelerate, that could be a difficulty for both Indian companies and non-Indian companies that provide things like road building equipment and so forth.
So you would keep your bets largely with multinational companies listed in India, their subsidiaries particularly, which are listed in India?
We would look at multinational companies with India as a target, but we're certainly looking at India. India is one of those countries, not only with an extraordinarily large population and a growing middle class, but you know, India has over time shown respect for minority shareholder rights, enforcement of contracts, many of the things that equity investors value when they look for companies beyond their own shores that they might want to invest in. And so we will continue to look for Indian companies that are well positioned to provide goods and services both on the subcontinent and globally.
All right, the big talking point for India has been the twin deficits, and India is on track to further narrowing its twin deficits. But how much focus, and just as an investment manager, I want to get your view on this, how much focus should there be on current account deficit and fiscal deficit when what drives interest in India is really its enormous growth potential? And with growth picking up, there would be an expansion in the deficits. I mean, we have developed countries which are struggling with the deficit situation. How realistic is it to measure a country on its deficit variables than growth potential? The important point there really being the ability to finance a current account deficit. So having adequate reserves is the key. And India nearly has about $300 billion in forex reserves. So from that standpoint, India is comfortably placed. In that light, how do you look at the twin deficit variables and compare those to the potential of growth that India is expected to show going forward?
Well, you make a very good point. A rapidly growing country, particularly that has big investment needs, you'd expect to see some of those investment needs externally financed, and that will increase such a country's current account deficit. The concern becomes if the current account deficit grows and there is a lag of investment. So if that current account deficit is growing and it's largely going to current consumption, global investors will look at that a little more cautiously. I think Brazil might be an example of a country where there's concerns about whether there is investing, for whether the current account deficit is driving investment. Quite frankly, that's not just an emerging market issue. I think that's been an issue for the last decade for the United States as well, as to whether we're borrowing to consume as opposed to borrowing to invest in our future. So India, as you point out correctly, has a comfortable level of foreign currency reserves, and therefore can expect to have, then can tolerate a current account deficit. The problem is if that current account deficit, it comes to the point you've made, that current account deficit is not associated with good economic growth and not associated with investment in things like infrastructure for the country's future, then it becomes more problematic from the point of view of domestic investors and international investors as well.
The other big talking point in India is growth revival that we just touched upon. Can India do 5.5% to 6% GDP growth in FY15 as is expected with political risk out of the way?
Again, I don't know that, again, from an international point of view, the election I don't think is the dominant issue. I think some of the economic management issues that we talked about are more important. I think it's going to be tough in the next year, given where the current situation for India to get back to 6% in 2014. But beyond that, I believe that moving back toward the 6 or 6 plus is absolutely within India's potential. Maybe even beyond that. Obviously, India was growing faster than that a few years ago. I think can grow faster than that again. But there's work to be done.
Okay, so then how do you rate the Indian market versus other emerging markets? Do you believe that from a market standpoint, and because you do these correlations pretty often, do you believe that at 13 times one-year forward earnings, India is in line with its historical average and thereby is fair value, or is there upside potential going forward, given that we've seen over the last 2 quarters earnings pick up as well, profit growth seen on the back of good operating level performance, may not be supported by sales growth as of now, but good operating level performance?
We'll see whether the elections, you and I seem to disagree a little bit on just how important the elections weigh on how investors look at the economy, particularly when many of us who are investing from outside India are looking at Indian businesses that garner a lot of their revenues from outside of India. In terms of valuations, markets do just fine from average or fair values. There's fair value, there's good money to be made by astute investors in average or fair valued markets. Fair does mean fair after all. What I would say is that a market that's on the less expensive side of where it's been long term and at 13 times one of the less expensive markets in the world, suggests to me that there will be opportunities for selective investors to go find Indian companies that are very well valued relative to their long-term growth potential. So I'm not sure it's an argument for buying the broad India position, but I'm sure it tells us that there are Indian companies that are very well valued and worthy of investors' attention.
Dr. Webman, you've spoken about India's need for infrastructure. What would make you look at Indian infrastructure favorably at this point? What would you like to see change in the sector that would perhaps make you a buyer? The finance minister, in his vote on account speech, has proposed more use of the public-private partnership model for financing projects.
Well, we would just like to see how this public-private partnerships, we've talked about that in the US, talked about it in Europe, talked about it in India. Is it going to be done in a way that lets the private side earn the kinds of profits that drive private companies? The difficulty becomes how much regulation there's going to be, how much opportunity there is, how much profit can be realized. So as the government becomes more comfortable with allowing companies to make a decent return on their invested capital, those companies will become more attractive to investors globally, locally as well as globally. So it really is a question of the level of control, the level of regulation, and the opportunities to participate in profitable investment projects. So that's the sort of thing we'll be watching to see if, in fact, how tightly controlled it is. And there is a public side. So obviously, public authorities want to make sure that public interest is served, and they're going to use regulation and some limitations to make that happen. It's just a question of how that balance continues to play out. And perhaps a new government will look at that in a way that's more favorable to private investors.
I also want to touch upon the other big talking point when it comes to India, and that's, the ratings downgrade, which was a bit of an overhang really for the markets. Do you think that India has averted a ratings downgrade with improving macros? S&P still holds a negative outlook. How much do ratings really mean for your view on India?
Rating agencies will do what they do. I think individual investors, frankly, are going to make their own assessments. So improving macro, with continuing good central fiscal control. I mean, there have been criticisms of, the government has reached for last year, reached its fiscal targets, but there's some concern that perhaps, accelerated dividends from state-owned enterprises, maybe looking forward some rather optimistic views about tax collections, what tax revenues will look like. What investors as well as rating agencies will look for is to be sure realistic assumptions are being made and that we're not producing good numbers today at the expense of growth or costs tomorrow. So we want to make sure that those numbers are appropriate. So the government needs to be aware that getting the target is great, but that investors and rating agencies are going to look inside the numbers that got you to the target and say, are those really reproducible? Were there one-time fixes? And have we robbed from future investment in order to meet current fiscal plans?
What about coordination and policy action between central banks across the globe? The collective approach. Dr. Rajan recently stated that central banks need to be sensitive to emerging markets in making their forward guidance, and an indication to, of course, central banks of the developed world. What is your expectation from what the Fed does next, and what do you expect from emerging markets in response?
Yeah, I was glad to see that there was some discussion between Yellen and Rajan at the G20 meetings. Obviously, I mean, one of the great strengths of India, by the way, I said I would not make any partisan comments, but India, in its Fed governor, does have one of the strongest and most respected monetary policy makers on the globe running the RBI. And so one has to take Professor Rajan's views very, very seriously. I'm glad that he and Professor Yellen had the opportunity to talk and maybe smooth out some views. In terms of what the Fed is doing, listen, what the Fed has recognized that the course of policy action, in particular, how much they reduce their what they call large-scale asset purchases, what we tend to call quantitative easing, how quickly they reduce that will be, as they put it, data dependent. So how fast U.S. growth takes off, and should there be any upturn in U.S. inflation, which is unlikely. I think they've been as clear as they can be, which is that, you know, we are going to watch the macro environment and adjust policy accordingly. That said, I also think they've been pretty clear that they intend to reduce the scale of those purchases by about $10 billion a month until they reach zero sometime in the third quarter or maybe beginning of the fourth quarter of this year. So it's going to be a little hazy, as you say, because the world is always a little uncertain. The economic world is uncertain. You know, in the U.S., for example, we often talk about India and concerns about the monsoon. If we don't get rain in California of significant extent in the next short while, you know, we could have an agricultural failure in what's a globally important part of the agricultural market. Now, I mention that not because that's a dominating effect, but because it's inevitable that a central bank that's trying to gear extraordinary policy, unprecedented policy to changes in the economic environment will have to recognize some amount of uncertainty as they look forward. All of that said, I'm glad that the Fed and the RBI are talking at the most senior level. I think coordination, central bankers should be open with their constituencies, but they should be especially open with one another so that they can plan what is appropriate monetary policy for their own region, for their own countries.
Fair point, Dr. Webman. Thanks very much for taking out the time and speaking with us, and we hope to see you in India very soon.
I'd love to have that opportunity. Thank you very much.
Thanks very much once again. Well, with that, we come to the end of this edition of the FII View. Catch you with another special guest next week. Till then, take care.